Morning everyone, welcome to the today's webinar on algorithmic trading in India, how to start the common pitfalls and the profit opportunities. And as usual, today's webinar is getting recorded. And myself, Rajendran, joining from Bangalore, along with me, our guest speaker, Mr. Rajib Ranjan Borah, the co-founder and director of iRage Capital and QuantInsti. He is joining from Mumbai. And if you want to know more about Mr. Rajib Ranjan Borah, he is an he is the co-founder and director of iRage Capital Advisory Private Limited and QuantInsti Quantitative Learning Private Limited, and he's involved in the high-frequency trading system for Southeast Asian markets, helping generate significant volume within the option segment. At QI, QuantInsti, Rajiv manages the core segment on option derivatives and also works with exchanges, financial and educational institutions to design educational programs. He had conducted workshops and conferences across countries in America, Europe and Asia. Prior to iRage Capital, Rajiv worked with leading HFT firm Optiver in Amsterdam, working on option derivative markets. He is involved in market making, high frequency, equity arbitrage strategies. I guess a lot of stuff on algo trading front. And before Optiver, Rajiv also a management strategy consultant with PricewaterhouseCoopers, where he assisted a consortium in setting up a national commodity derivative exchange. I guess he has a tremendous experience in HFT and algo trading stuff. I request you people to come up with interesting questions. Probably we can take the questions during the middle of the session as well as the end of the session. Right? If you have any questions which is relevant to algorithmic trading or HFT or low frequency trading techniques or automated trading techniques, anything which is relevant to Indian markets, I guess we have a wonderful guest to answer your questions. And Rajiv, I'll just hand over the screen to you.
Okay. Yeah, hi. Good morning, everyone. I believe my screen is not shared with all of you right now.
Yes.
So now I guess all of you can see my screen. Okay. So thanks a lot, Rajendran, for the invite. Thanks a lot for the wonderful introduction. And there was a slight confusion, so I thought this was more of a meetup in the sense a discussion rather than a one-way webinar. So that is how I have structured it. So I thought, let me just take all questions that you guys could have, and then you could just shoot me questions at any point of time throughout the day, and then we could keep answering, solving the answers, answering the questions that you guys might have in real time. So let's do it that way. Okay, so because I thought it would be a discussion rather than a presentation, so I actually didn't have a very robust presentation with me, but I can take any questions as and when you have them. Okay, so let's start with
You want to pull out some questions now?
Oh, no, that's fine. Yeah, so can you guys see my screen?
Yes, it's good and fine.
Yeah, you could see the presentation, right?
Yes, exactly.
Okay. Yeah. So out of the 54, out of the 60 plus people who have registered now, so how many of you have already been trading algorithmically in the markets so far?
I mean, you can answer the questions in the question section. There is a chat section on your right hand side of your screen, so you can put your questions over there, and you can even answer your questions in the Slack channel. We have one more Slack channel running up, Rajiv, so where it's exclusively for Divergence members. They are also joining up in this webinar, right?
Okay.
So I'll be volunteering the questions on behalf of the people.
Oh. Okay, so basically, the question was to gauge how many of you are new to this domain and how many of you are totally have some experience in this domain. Now, if you look at it, algorithmic trading in India became truly possible since 2008, when SEBI said that they would allow direct market access and so on and so forth. So prior to direct market access, what does it mean? People had to access the markets via brokers. So you send your orders to the brokers forward it to the exchange, and so on. So post direct market access, people could actually send orders directly to the exchange. Now, which would mean that if you have a trading strategy, now you just get more data from the market, you respond to it, and that's it. So there is no delay or latency introduced by the broker. So because there is no delay or latency introduced by the broker, if you see an event and you respond to it, that's it. It's not like you see an event, you respond to it, but then the order gets stuck at the broker, and then the broker has not forwarded the order to the exchange, and then therefore your order reaches at a different point of time compared to when the event had happened, and therefore it wasn't truly very effective. So now with DMA, it truly became effective. So the segment has truly picked up post that. So in fact, in 2008, 2009, I was working at Optiver, which is the biggest high-frequency trading firm in continental Europe and also Australia Pacific, Asia Pacific, Australia. So I remember at that point of time, a lot of algorithmic traders from across the world were running back to India. So in fact, on today's date, the few biggest Indian homeborn algorithmic trading firms that you have today are all formed in 2009. And then the surprising thing is, funny thing is, everyone was speaking to each other at that point of time about collaboration and so on. Some people ended up collaborating, some people ended up forming on their own. So so basically the industry truly started in 2009, and then most of the big players that you have today, a lot of them actually started in 2009, and then it's like a lot of us are very good friends, and then we know each other and so on and so forth. So the market started in 2009, and then there was a kind of revolution post that. If you look at the volumes in the markets, the growth in volumes in India through algorithmic trading has been phenomenal, and then which has led to growth in volumes in the exchanges too. Now 2009 is like 2008 is like 9 years back. So I'm not sure how many of you were still trading the markets at that point of time, but then those of you who have been trading for the past 10 years or so, you would have realized that volumes in the exchanges, especially in segments like equity options, the option segment specifically, and then within the option segment, equity options, the currency segment, currency option segment, have grown phenomenally. And then that's because for the option segment, derivatives, for the options and derivatives segment, automation helps drive volumes. That's because the price of a derivative is derived from the price of some other underlying. Now, therefore, you have some base to price the derivative, right? So, therefore, algorithmic trading is way more popular in the derivative segments, in the option segment and so on, where you could derive the price from an underlying. So, likewise, instruments which have linked products. So if you have a stock with derivatives, it would have higher volumes because people could trade the relationship between the stock and the future and the stock and the options and so on. Or if you have two stocks in the same segment, you could trade it. So basically, coming back to the original point, volumes in the exchanges grew drastically after the introduction of algorithmic trading in 2008-2009, and then subsequent to that, because India, the growth of algorithmic trading started a bit late, so we could very quickly and very conveniently adopt some of the best practices that were happening globally. So because we could adopt some of the best practices happening globally, it was very easy for us to jumpstart in our growth, accelerate the process of adapting algorithmic trading. And in 2010 itself, the introduction of tick by tick data happened. So I'll come to all of those. The architecture of an algorithmic trading platform, what components contribute. So basically, if you want to do algorithmic trading, you would want to know what are the different components of an algorithmic trading system, components connect to each other and work with each other, right? So we would discuss all of those and so on and so forth. Yeah. So in that context, tick by tick and all those things, the evolution of algorithmic trading in India would make sense. Okay, so the next thing is this slide. You can see how algorithmic trading contributes the contribution of volume through algorithmic trading at CME, for example, versus contribution of volumes through algorithmic trading at NSE or at MCX in India. Likewise, if you look at algo NYSE and other destinations in Europe, in US, and so on, you would see how algorithmic trading is a way bigger domain there. So the good thing is it means that we had been picking up pace and then following the US and Europe in terms of best practices, and the gap between what happens in the US and what happens in India is very quickly reducing. So we are, which means that we would be getting there very, which means that if you see 70% volume participation through algorithmic trading in the US, in India we are not very far off. So, let me do one thing now. Let me just very quickly describe the architecture of an algorithmic trading platform, so that when you guys anyone plans to start an algorithmic trading business, you need to know how to, the first thing you need to know is there an algorithmic trading platform that you can straight away pick up which will meet your requirements. So the first thing is whether there is a platform which meets one. Okay, so let's start from the beginning. The first step is whether there is what type of trading strategy you want to trade. Now, once you have made the decision about which trading strategy you want to trade, you do all your profitability analysis and so on and so forth. So even step one has a few child steps. So, for example, you make your trading strategy hypothesis. Then you need to check the hypothesis, the robustness of the hypothesis. So what you do next is you do your validation of hypothesis through backtesting on historical data. Validation of hypothesis through backtesting on historical data. Okay, hi Ravindran. So if people have questions on the Slack window,
Yeah.
can you provide me the URL to the Slack window as well? Because I typically prefer very interactive sessions. So
Okay. So I guess not everyone on the Slack, and some of them are on the Slack, some of them are on the GoToWebinar. So I generally I'd like to volunteer the question. I'll provide you the Slack access anyways, but I think it might take some more time. So I can invite you right away. 1 second.
okay, so just forward the copy paste and forward the questions on the chat window then.
Sure. I'll do that. I'll do that. Yeah.
Yeah, That will be wonderful.
Yeah.
Okay. Okay. So the next thing is once you have validated. So basically, what is this? This is the trading strategy formulation. So first, you would make a hypothesis. You would say that okay, I think probably whenever event A happens in the market, there is a huge likelihood of event A being followed by event B. Now this is just a hypothesis. You don't know whether it's true or false. You said that. For example, event A could be when the implied volatility of options drop by 5% in a 2-minute time frame. The event B could be implied volatility should go up. So the hypothesis is whenever event A happens, it is likely to be followed by event B. So you should trade in anticipation of event B. But then you don't know whether event A is truly followed by event B, right? So you need to validate your hypothesis. So to be able to validate your hypothesis, what you need to do is you need to run statistical tests on historical data. So throw statistical backtesting on historical data. Okay, so the next part is, say you've done your statistical backtesting on historical data and then your hypothesis turns out to be true. What do you do next? You then figure out what is the best way to execute that strategy. Do you want to trade that manually? Do you want to trade that algorithmically? So the decision to trade algorithmically, manually. Now, how do you make this decision whether you should trade algorithmically or trade manually? So that is one of the key points of today's webinar as well, right? So a lot of you are, if you have a trading strategy, how does trading algorithmically help? Okay, so say you have hit the sweet spot, you have figured out how to make money in the markets. Now, what is the next thing that you should do? Now, the lifetime of trading strategies is not infinite, so you should try to make best the discovery that you have done till you can leverage on it. Now, how do you make best? You try to scale it up as much as possible. So if a certain phenomenon is discovered in stocks, you would want to trade in on as many stocks as possible for as long as possible. If you try to do it manually, you would probably be able to only trade, say, 5, 10, 15, 20 stocks at a time. But then if you find a profitable trading strategy which works across the broad spectrum, then you would not want to just trade it on 5, 10 or 15 stocks at a time because of human restrictions. So if you trade it manually, your human eyes can only track 15 prices at the same time, or 20 prices at the same time if you're slightly superhuman. But then you won't be able to track patterns in more than 20 stocks at the same time at all. So the first thing if your strategy is scalable, so the decision is whether it's scalable across instruments. If it's scalable across instruments, then yes, go algorithmic. 2, how much of monitoring and how much of decision making is involved in the strategy. So if the strategy involves waiting for a certain pattern when the pattern happens, you are definitely going to take an action. If it's about monitoring and acting versus decision making on the fly. So the moment an event happens, if the events are so complex that you have to make a human decision, versus if the moment when the event happens, you just have to act on preset logic. In case 1, you would do algorithmic, because you don't want to sit in front of a computer screen staring at the screen all the time waiting for an event, and then the moment the event happens just acting on that event. That's not efficient. So if your trading logic is simple and then it's predefined, and then you need to act precisely on an event, you would rather want to do it algorithmically than doing it manually. Well, why is it so? Because you also have higher uptime. So if you have higher uptime requirement, so for For example, if being out of the market even for 5 minutes, 10 minutes, 15 minutes might impact you a lot, then you would rather do it algorithmically. And or it's even possible that it could be the other way around too. If the strategy involves monitoring the market throughout the day, and then you might get an opportunity, say, only once in a day, but then say at that point of time you are not in the market, you have gone out on a lunch break or a toilet break, so you miss that opportunity. So you have stared at the computer screen the whole day, and then you were out of your seat for 5 minutes, and then the opportunity arose, and then you missed the opportunity. So you wouldn't want to do that. In that case, going algorithmic makes sense. The next thing is, if your strategy involves taking positions in a huge number of instruments, or making a lot of very quick trades. Okay, so positions across huge number of instruments. If your strategy involves the need to take positions across huge number of instruments at the same time, so basically you would have positions in say 10, 20, 100,000 instruments at the same time. In that case, risk management and position management will be easier to do if you do it algorithmically. So say you have positions in 50 different options or 100 different options at the same time. How do you know what is your overall portfolio exposure to change in interest rates? How do you know what is the overall portfolio exposure to an increase in volatility, an increase in the price of the market, and so on and so forth? So if you have positions spread across a multitude of instruments, doing risk and position management becomes easier with algorithmic trading. Okay. Now the next factor which determines whether you should go algorithmic or try continue doing manually is if your trading strategy involves doing a lot of quick trades. Now, if you have to do a lot of very quick trades, doing it manually, you are liable to make a lot of mistakes. So, in which case, you wouldn't want to do it, right? So, lots of trades. If you have lots of trades, you should do algorithmic. Or if the opportunities are very short-lived. Now, okay, so tell me, guys, what do you think is the response time of a human being? What do you think is the response time of a human being to an event? Okay, so let me give you I guess the session so far has become a little drab and boring, so let me give you some interesting real life examples. So in 2013, I was at the FIA in Chicago, which is one of the biggest conferences on algorithmic trading and trading in general, actually. So it's one of the biggest conferences on trading in general, and then that event is probably 3,000, 4,000, 5,000 plus people attend that event. So there was one, it should be more than 5,000 probably. So there was one algorithmic trading platform which wanted to advertise their platform. So what they did was they had a game at their stall. So they said that, look guys, here is an iPad, and on the iPad there is one button, big button. The color of the button is blue. The moment the color of the button changes from blue to red, you just have to tap on this button, and that's it. And your response time to it will be measured. So the moment the color turns from blue to red, you have to tap on the screen. Your response time is measured, and whoever could do it fastest across the 3 days of the event could would get that iPad for free. So that was a game that they had, and they said that if you could, the person who could tap the iPad fastest after an event would get to keep the iPad. Now, across 3 days, the fastest that anyone could do was slightly above 170 milliseconds. Now, it was a very simple thing to do, right? You had to just look for one event, which is the color changing from blue to red. Your action was also very simple. You had to track something which was very simple. Your action was very simple. You just had to tap on the screen. That's it. The fastest that a human being could respond was 170 millisecond. What is 170 millisecond? .170 seconds. Okay. Now, how much time do you think? So this is when both event and actions were very simple. Now, on the other hand, when you see opportunities in the market, these are very complex events, number one. And number two, the actions are also very complex. So you need to determine what instrument. So you need to bring up your order entry window. You need to say which instrument you want to trade in. You need to say at what price you want to trade in. You need to say at what quantity you want to trade in. You need to say what type of orders you want to send, whether it's an IOC, market, limit, and so on. And then number four, you want to say whether it's the buy side or the sell side, and so on. So there are a lot of inputs that you have to provide. So the moment an event occurs in the market and you respond manually, if you do it manually, event figuring out that the event has happened, because these events are hugely complex, and then by the time you have sent out the orders, because the actions are also complex, it would be in the range of 1 second plus. If you do manually, it's going to be in the range of 1 second plus. So that's the kind of latency that a human trader would have. Now, in contrast, if you do it algorithmically, what do you think, how much is the time that an algorithmic trading system takes? What do you think is the amount of time taken by an algorithmic trading system to respond to events? To respond to not just simple events, to complex events. So a computer system responds to market events in the matter of microsecond, which is 0.0000001 second. This is the scale at which an automated trading system responds to events. Now, if it's a very standard event, so basically most of us know that when the price of the underlying goes up, the price of the call option should go up, the price of the future should go up. Therefore, all of us are tracking the markets for, say, similar types of events, and then a lot of us are responding to it in a similar way. Now, if a lot of us are responding in a similar way, a human being who will take at least 1 second to respond, versus an algorithmic trading system which would respond in single-digit microseconds. So it need not be 1 microsecond, it could be, say, probably 5 microseconds. But you get the difference in scale, right? So if the opportunities are short-lived, then go algorithmically. Or if the strategy is fundamentally very common, in which case it's basically saying that whenever the price of the underlying goes up, the price of the option is going to go up. Now everyone responds to it the same way. The only difference is I think that the price of the option will go up by say 2 rupees. Someone else will feel that the price of the option will go up by 1 rupee 95 paisa. A third person might feel that the price of the option will go up by 2 rupee 10 paisa. The extent to which we differ in our belief could be there, but then fundamentally all of us believe in the same logic. If fundamentally all of us believe in the same logic, the first one to respond will get a better fill, will get a better trade. So even though I might be wrong, I believe that it should go up by 2 rupees, but then actually theoretically and practically it should probably go up by 2 rupee 10 paisa. But then because I am the first one to respond to it, I get the trade, and then even though you were more correct in your prediction, but then you never get to do the trade because you were doing it manually. So therefore, if the strategy is fundamentally very common, the person who leverages the power of technology to respond faster gets to do the trade, and the person who does not leverage the power of technology does not get to do the trade. So therefore, in such situations, you would want to do it algorithmically. Well, plus there are constraints as well. What are the other constraints? The other constraint is opportunity versus cost. So we can discuss all of this as well. So it's possible that you have hit the sweet spot, you have found a trading strategy, but then say it only makes a few 100 rupees a day, and the cost, and then it's a very costly, complex algorithm to implement, and then you can only implement it on a standard trading platform. In which case, the cost of the platform could be way higher than the profit opportunities and so on and so forth. So those are other questions to have. Or it's possible that your trading strategy is based on some technical analysis, for example. While I personally don't believe in technical analysis, but then say your trading strategy is based on some technical analysis methodology. Now, you do your charting, and then based on your charting, whenever the opportunity arises, you have to do the trade. Now, it actually meets a lot of this criteria. So instead of manually monitoring and tracking and so on, if you can actually let a charting platform track and then the markets for certain charting patterns and trade automatically, then it can start doing it across hundreds of stocks and so on and so forth. So it meets a lot of these criteria, say, and therefore it becomes a candidate for doing it. But are there trading platforms which allow you to code a charting pattern into an algorithm? So it's how easy is it to convert an charting pattern into an algorithm, write it in the form of a trading code? So those are other questions that you have. Complexity of coding the strategy. If it's way more simpler to just implement the strategy manually, because it's so very complex that programming it on a platform is difficult, would take up so much time, and then you would not have confidence on the platform whether the implementation is correct or not. So in that case, probably it might not make sense. Okay, so let me now do one thing. Let me just take a bit of a quick break. So what do I mean by quick break? I'm going to read through all the questions which have been put up so far, which have been forwarded to me by Mr. Rajendran, and then I'll try to answer them one by one. So the first question is, what are the algos prevailing in the Indian options market? Okay, that's an interesting question. I think this is more relevant as we go start discussing platforms and so on. But then, okay, since the question has been discussed, let me try to answer it as well. So there are various types of algo trading strategies, and there are various algorithmic trading platforms which are prevalent in the Indian options market. On the high end, you have this platform built by a firm in Sweden, which is Orc software. So this has been bought over by merged with a firm called Itviti. So Orc was a part of Itviti, and then they merged with Cameron Tech, and so the combined entity is now called Itviti. So Orc is one of the more sophisticated high-end platforms. So this is used by a lot of players to do things like algorithmic trading, market making. So for doing in market making, the market maker needs to respond to changes in events in the market and changes in prices in real time, and then probably end up sending a few hundred orders per second throughout the day, and end up doing a few thousand, a few tens of thousands, or a few hundreds of thousands of orders, trades throughout the day. For such systems which require huge, complex, and highly scalable implementations, wherein you have to respond very quickly, you have to do a lot of operations in the sense number of orders, number of trades, and so on. You would want a platform like say Orc. Similar to Orc, there was another platform a few years back which was known as Flex. So I'm talking about platforms which work for the Indian market. So this is another platform. I'm platforms first. So these two are platforms which work for the high frequency trading business and so on. Now,
these are execution platforms, or just an backtesting platforms alone?
okay. Okay, so these are trading. These are execution platforms. So even within trading platforms, I actually differentiate between. Okay, so these are execution platforms, and then they also come with their own backtesting modules and so on and so forth. So I'm going to actually touch upon what are the different components of a trading system, automated trading system, so that if you feel that you need to go algorithmic, then how do you make the decision? So these are the two global names that first come to my mind. Then you also have a series of homegrown systems. So you have Omnisys, which was bought by Thomson Reuters. And then you also had a platform known as Greeksoft. Then you have a platform known as Symphony FinTech. So in case of Omnisys, Greeksoft, they actually come with prepackaged off-the-shelf products. So they would give you a 2-leg, 3-leg IOC order, or a option straddle strangle trader, or a put call parity trader, or a butterfly trader, or a risk reversal trader, and things of that sort, or a option ratio trader, and so on and so forth. So you could basically, in case of Greeksoft and Omnisys, you have a lot of such prepackaged strategies. So for example, just to elaborate, a straddle strangle trader, what does it do? You could say that, okay, I want to buy the 9,100 Nifty straddle, if and when the price drops down to 200 rupees, and if and when the price goes up above 205 rupees, I want to sell it. So it will keep monitoring the market throughout the day. The moment the price goes below 200, it will buy it. The moment the price goes above 205, it will sell it. So, and then you can also configure the way in which it will respond to events. So you could say that, okay, the moment the price comes in the vicinity of 190, 200 and 200.20, just keep sending buy orders and so on, and then yeah, some of them could go get filled. Or you could say that the moment the price drops below, only then respond to it, and so on and so forth. So you have a lot of off-the-shelf products wherein you just buy the product, you pay the firm, the vendor, a fixed amount of money for using the product every month, and then and then you trade whatever the product has been given to you, and then you just trade that strategy. Flexibility that way. In contrast, some of these platforms, you could also go for the CP module, in which case you could actually code your strategy within the platform. So one is you just buy an off-the-shelf platform, off-the-shelf tool, which in which case you don't have any flexibility. If they give you a straddle strangle trader, you have to use the straddle strangle trader. You cannot do anything else. But then if on the other hand you buy a platform with the CEP, in that case you would be able to do a lot of things on your own. You could modify the code, you could actually write a completely new strategy from scratch, and so on and so forth. So let us actually look at an algorithmic trading platform, in which case when we look at a platform, the different components of it, you would be able to understand that better. So once I continue this flow, then things will get slightly more clear, I believe. Okay, so the next question is, which is the better platform to backtest and execute option strategies, pair trading strategies? Well, different platforms have their different pluses and minuses. One more platform that I missed to explain is the platform from Symphony FinTech, for example. It's great because you could interlink it with a lot of other tools, and yeah, so the two more platforms that I actually missed, the current flavors of the season, Kite, Zerodha, and Interactive Brokers. You could actually code your strategies on those platforms. So they give you the APIs for retail guys to code on a platform and then trade it on that platform. Probably Kite and Interactive Broker might be interesting propositions. Okay. The next question is, are market makers in India, are they algorithmic? Okay, so I'll just take 1 minute to explain what a market maker is. So a market maker is someone who provides continuous buy and sell prices throughout the day. Now, if you're providing continuous buy and sell prices throughout the day, what are your risks? Your risks are, you have provided at a buy price and then the price of the underlying drops down. If the price of the underlying drops down, you will end up buying at a wrong price. So as a market maker, you should constantly be aware what is the fair valuation of an asset. As a market maker, you have to be constantly aware what is the fair valuation, and based on your constant updates on what should be the fair valuation, you should modify the prices accordingly. Now, how can a market maker be more profitable? A market maker is profitable if he keeps doing a lot of round trip trades, which is basically buying and selling, buying and selling, buying and selling. So the market maker tries to buy at a price X and sell at a price slightly above X, and then the difference between the buy price and the sale price is what the profit the market maker makes. Now, if the market maker, the risk of the market maker is holding on to position, the profit is basically the difference between the buy and sell prices. So it's in the market maker's benefit to therefore try to not hold positions for long and keep doing a lot of trades, and lot of trades on both sides. The best way to do that is therefore by reducing the difference between his buy price and the sell price. Now, if you say that, okay, if the fair valuation is 1,000, I'm going to buy at 900 and sell at 1,100, probably not many people are going to trade with you, because if the fair price is 1,000, no one is going to buy from you at 1,100 and no one is going to sell to you at 900. But if you say that, okay, hey, the fair price is 1,000 and I'm willing to buy at 999.90 and I'm willing to sell at 1,000.10, then you are going to get a lot of buyers, you are going to get a lot of sellers. So you are going to increase the probability of doing a lot of round trip trades. So the market maker makes profits by doing a lot of round trip trades. The market maker reduces his risk by not holding inventory. Now, both of them work better if the market maker provides codes which are very the difference between the buy and sell prices are very close. Okay. The second thing is the market maker has to be fast, because if an event happens and then the rest of the marketplace comes to know about the event before the market maker, and then they hit the market maker on the wrong side, So the fair valuation was 1,000, it goes to 1,200. All the market participants see that the market maker is still willing to sell at 1,000.1, so they are going to hit it. So therefore the market maker has to be fast, the market maker has to provide tight codes. Now, how is it possible? Is it possible manually? Or is it possible algorithmically? Well, it's possible manually, but then a manual market maker will not be able to adjust his codes very fast in response to an event, because manual trading takes at least 1 second plus to respond to an event. An algorithmic trading system will respond to events very fast, because the market maker needs to respond to events fast so that he does not get hit on the wrong side. It becomes almost mandatory for him to be an algorithmic trader. Plus, to be able to do market making effectively, you have to provide very tight bid-ask spreads. If you have to provide very tight bid-ask spreads, then you have to, the margin of error is even less. So you have to respond even faster to events. So therefore, the most effective algorithmic trader market making is through algorithmic trading. If you are doing well, so that is also the reason why the bid-ask spreads in the markets have dropped down drastically. So earlier, if the fair price was 1,000, you would have to buy from someone at 1,002 and sell at 998. But today, if the fair price is 1,000, you could probably buy at 1,000.10 and sell at 999.9, or even better. So with the advent of algorithmic trading, the indirect cost to the rest of the market has dropped down drastically, because the market makers have made it much more efficient. And not just that, for complex products like options, wherein you have to do a lot of calculations to arrive at the prices. How many of you have looked at the derivation of the formula for options, the Black-Scholes formula, and so on and so forth? So derivation of option formula is hugely complex. So doing this manually would take up so much time, but doing it algorithmically is just a matter of microseconds. So therefore, the segment which benefited the most from the introduction of algorithmic trading is the option segment, and market making in options became way more easier with the introduction of options, algorithmic trading. Okay, so next one is how to reduce slippages, what order execution logic reduces slippages. So there are various, okay, this is about strategies, ways of implementation within strategies. So let me do one thing. Let me touch this question specifically after discussing the platforms. The next question also, let me pick it up after describing the platform, components of a platform.
Rajiv, there is one basic question there. What is the difference between algorithmic trading, automation trading, or quantitative trading? Are there any basic differences in these terms?
Okay, so yeah, let me pick that one. So as far as I am concerned, automated trading, algorithmic trading are the same. Now, quantitative trading is the science of using statistics and methodology in trading. So basically, it's basically doing trading through a systematic, objective, structured way, rather than on winsome fancies and then on discretion and on gut feeling. So basically, it's saying that a lot of traders, they said, oh, I think the market is going to go up, let me buy. I think I get a good feel about this stock. So that is discretionary. In contrast is quantitative trading, wherein you said that this is a structured objective way of trading. So you would make your trading decisions on the basis of numbers, on the basis of numbers alone, and it could be fundamental numbers, which is what is the PE of the stock and market cap of the stock and profits in the last X quarters, dividends, and so on. Or it could be market-based numbers, in which case how much has the price gone up, price gone down, and what is the volatility of the stock, and so on and so forth. So these are at a very broad level, very broad level, two different categories. Within quantitative trading, now quantitative means it's rule-based. If it's rule-based, you might as well implement the rules in a computer program, which is a computer algorithm. So if you implement it using a computer program or a computer algorithm, then the execution of the same becomes automated. So therefore, computer-based trading, automated trading, and algorithmic trading is the same. Okay. Now there is another term that exists in the literature, which is electronic trading. What does that mean? It actually means just sending your orders to the exchange not doing it manually through a broker. So it's not the old-fashioned way of calling your broker and or shouting at the pits and trading. It's just using the electronic APIs to send orders. So it could be automated. It could be manual also. So this could be anything. This could be either discretionary or quantitative. And if electronic trading, the orders do not, you are connecting to the APIs manually, so then electronic trading you can do by connecting to the APIs manually, which is similar to using the brokerage terminals that you have, so retail brokerage terminals. So for example, ICICI Direct or HDFC Securities, or say even the Kite Zerodha API, wherein you have to log in manually to trade. So all of those, you are sending orders electronically. It's not, you are not using an automated the logic is not the execution of the logic is not electronic. The sending of the orders to the exchange is electronic. So within electronic trading, you could have the execution of the logic could be manual, or the execution of the logic could be algorithmic. So if it's the execution of logic is algorithmic, then you have automated and algorithmic trading. So electronic trading is just the sending of orders using the electronic the APIs, rather than sending it by calling the broker and so on. If the execution of the logic which invokes the API is automated or algorithmic, then you have the automated or algorithmic trading. Another term that exists is high frequency trading. High frequency trading definitely has to be algorithmic or automated, because a human being cannot send out orders. We have already seen the amount of response time that a manual trader has versus the amount of response time that a automated trading platform has. So given that the automated trading platform has a response time which is in a different world altogether, therefore high frequency trading, which is basically trying to get in and get out of positions very quickly and then having very short response time and so on, is only possible using algorithmic trading. Okay, so I hope I have explained the differences between the various terms that exist, and then people actually misuse various of these terms very easily. So electronic trading, probably 99% or 95% of the orders in the exchange could be electronic trading. Now, when people are criticizing high frequency trading, they suddenly say that, hey, look, 95% of the trades are because of electronic trading, so high frequency trading is bad. Now, there is no linkage. High frequency trading is algorithmic trading, wherein the need for speed is in sub-millisecond. That is 0.001 second or less. Need for response time is in sub-millisecond or lesser. So high frequency trading is a form of algorithmic trading wherein the need for response time is sub-millisecond or lesser. Now, electronic trading might not be algorithmic, and electronic trading is contributing 95% of the exchange volumes. But it's not the same thing as high frequency trading. So when people criticize and say, oh, look at electronic trading doing 95% of the exchange volumes, and therefore high frequency trading is bad, so therefore the link between both actually is missing. Okay, so the next question is a very interesting question. So someone asks, why do these big companies, JP Morgan, Goldman Sachs, etc., hire traders? If algo have edge over physical trading, they have unlimited amount of resource, funds, etc., etc. Okay, so a few months back, last month, there was one very interesting article, so which said that Goldman Sachs is replacing 600 traders. 600 traders. What is it replacing with? 2 traders and 200 programmers. These 200 programmers would write the program which the 600 traders were doing, and 600. So basically, they are going algorithmic. So they said that instead of 600 traders, we can have 2 traders doing the same thing, and then this 200 programmer would write the program to do the trading decisions that these guys were doing. Now, at the end of the day, you still need people who look at the markets, to analyze the markets, and to figure out patterns in the market. So the role of the trader is shifting. You still need traders, but then the role of the trader has become much more analytical rather than operational. So traditionally, what would a trader do? A trader would stare at the monitors and then keep looking for patterns in the market. So the trader already knows that if the pattern X occurs, I need to respond with an order of type Y. Now the trader just keeps staring at the monitor waiting for event X. The moment event X happens, he would furiously type in his orders in anticipation of event Y. So he would say that, oh, the price, say the same stock is trading in 2 different exchanges, and then he would say that the moment the price difference of the same stock in 2 exchanges differs by, say, more than 0.1%, he's going to trade in exchange 1, buy in the exchange which is lower price, and sell in the exchange which is higher price. So the whole day he's just staring at the price of the same stock in both the exchanges, the whole day. The moment the price difference between both the exchanges becomes 0.1% or more, he is going to furiously type in his orders to send a buy order in one exchange and a sell order in another exchange. That's all he's doing. So now, in contrast, with the introduction of automation, the trader does not have to monitor the prices. If an event happens, the automated trading system will figure out that an opportunity has arisen. If an event happens, the automated trading system will not just figure out that the event has arisen, it would also send out an order. If monitoring the markets, executing orders, the 2 most tedious tasks within trading are now taken over by computer algorithms. Now what does a trader do? Well, the trader, instead of doing monitoring the markets, instead of furiously typing in orders, if the trader is freed from these 2 tasks, he's now freed to do the more sophisticated work of analyzing the markets. So therefore, the trader's role has shifted from being someone who monitors, someone who executes orders, to someone who researches, analyzes, looks at relationships, and then once he figures out relationships, works with programmers to feed in those relationships into a trading platform, automated trading platform. So that's why, as in case of Goldman Sachs, you see 600 traders replaced by 2 traders and 200 programmers. So that is what would happen. So if you have a profitable trading strategy, you would want to do it algorithmically and so on. Okay, how many percentage algo trading at NSE, BSE? I already showed you that slide. So, I think the answer is somewhere around 40% plus trades in NSE are through algorithmic trading. The number of orders could be even higher. The because algorithmic traders have the ability to respond very fast to events, and then they can make small price changes. They never get bored and tired, right? A computer would send out 1 million order a day, but a human being cannot send out 1 million orders a day. So automated trading systems replace a lot of orders, because if they know that the fair price is 997, then it would be willing to buy at 996.95, and it would be willing to sell at 997.05. So therefore, automated trading platforms, the price order replaces are way higher. In contrast, a human being will just not be able to do it. So therefore, the number of orders from algorithmic trading platforms is way higher. The participation by in terms of trades is probably 40% plus. Okay, the next question is, what are the prerequisites for algorithmic trading? What are the prerequisites for algorithmic trading? Okay, so the prerequisite would be, okay, so let's look at it in another way. Say you are interested in driving a Formula 1 car. You could just sit on the Formula 1 car, drive, and go back home. Or you want to drive it very well. In which case, what would you want? You would actually get into the Grand Prix, for example. You want to be a Formula 1 driver. In that case, you would want to understand the internals of the car very well. You would want to understand what affects speed, what could impact speed, how everything about the car. So likewise, if you want to be an algorithmic trader, you need to understand the platform in and out. Because if your platform isn't working well today, because of whatever reason, you would not make money. So you need to know how to implement your strategy on the platform best. And with algorithmic trading, because you need to the number of orders, the number of trades go up exponentially, you need to have an ability to analyze those. So a bit of scripting and coding experience helps, because you would also need that if you want to code the strategy on your own. So there are two things that you could do. You could get someone to implement it, or you could buy and directly off-the-shelf implemented strategy on your platform. Or you could just buy an already implemented strategy and then trade it. But if you want to implement it on your own, then you would need to understand how to code so that you could change the strategies on the CPA. It's possible that you are not a very sophisticated programmer, but then if you can understand how to read code, in that case, say the trading strategy you want to change from a 5-day moving average to a 6-day moving average, or from a 5-day moving average to a 10-day moving average, or change from 5% to 7%, then if you can understand how to read code, then you would be able to make those changes and have the confidence in yourself. But if you don't have that skill set, then you would have to be totally dependent on a programmer. And if you are totally dependent on a programmer, then that introduces lag time. Plus, say you have a trading strategy, it's complex, it was implemented by a software programmer, but if you can understand code, then you can figure out if it has been implemented correctly and properly by the programmer, versus if there are logical faults in the implementation. Is algo trading allowed to individuals in India? If yes, what are the legal compliances we have to? Okay, let me take the slightly later in the day. Let me copy this down as one more question. Which programming languages are used for coding? Okay, that's a very interesting question. So various platforms have various languages. Now, it depends upon the kind of strategy that you have. If your strategy involves doing a lot of quick trades on very short-lived opportunities and then say sending out few millions orders per day per server, in that case you would want to implement it on a program like C, C++, which helps you to build robustness in the code. But in contrast, if it's based on analyzing a huge amount of data and sending orders based on sending a few orders per day on the basis of hugely complex statistical analysis. Now, for statistical analysis, C, C++ is not the programming language. So you would probably want to use a packaged programming language like Python, which also has various packages available for quantitative analysis. So there are programming platforms, automated trading platforms which support Python. So these are mostly for platforms wherein you could you have to do a lot of statistical analysis and send out very few orders and so on, and not have a very robust need for speed. So if flexibility, convenience, complexity of calculation, the mathematics involved, the statistics involved, that is of prime concern, then you have go for program. Then such platforms would typically use programming languages like Python. If robust automated trading systems which have to process like few tens of gigabits per second and then send out huge number of orders at very low response times, that is in terms of single digit microseconds, then C, C++ is the language to be. Okay, now the next question is, can we say algorithmic trading is equal to trading with computer bots? Interesting question. Probably yes, you could say so. Well, next question is, when we talk of slippage, what is it compared with? Is it VWAP, made of, bid ask, any standard being followed? Okay, there are various metrics that are used. So if you get time later in the day, I'm definitely going to touch upon this. Okay, the next thing is, hi, I want to know how someone from non-IT educational background learn about programming. Well, it's not rocket science, number one. Number two, it's not complex. So in fact, there are lots of examples of people, of some of the best programmers actually being from non-technical backgrounds entirely. So it's entirely depends. If you're smart, if you have the time, and you pick up, and then you have the perseverance to not run away in the middle, you can always pick up programming. So even in our educational program, so we have an educational program at QuantInsti. So in our educational program, we have had students from 40 plus countries. It could be 50 plus countries as well. I haven't checked the latest count in the last 2-3 months. So we have had thousands of students, hundreds of students in our core program, and then plus the rest of the program. So I have seen examples of people who are from non-technical backgrounds who have picked up programming like anything. So so rest assured, prior background is never a hindrance. Okay, so the next question is cost of the setup for algo trading platform. And if a person does not know coding, then is there any service provider for coding keeping the privacy of logics? Okay, so that's a very interesting question. So a lot of these platforms also have their in-house development team, wherein they would dedicate a resource for implementing the strategy, your strategy, on their platform and charge you for it. But the privacy is, you have to trust those guys, that's it. And their core strength is implementing strategies. And so, for example, in case of Symphony FinTech, they do develop strategies of various individuals on their platform, and they do it for a fee. So Symphony FinTech, they have a platform, Symphony Presto or something. So on their platform, for a fee, they implement your trading strategy, they understand your strategy, implement it, and provide it to you. Or if you have a strong scare about privacy, I could suggest that in that case you would have to hire a programmer yourself.
Rajiv, in which case one have to go for an algorithmic trading with Ami Broker or Ninja Trader kind of platforms, like the technical analysis tools? So in which
Okay,
case one
so
have to go for an Python, because this is a very many question, because many people in India got used to tools like Ami Broker and Ninja Trader, and very few coders are able to code with Python or R. I mean, how do you suggest which one to go in what case?
okay, so I've never seen ME Broker and Ninja Trader. I believe these are for technical analysis. But then I also know that from my discussions with Mr. Praveen Gupta and JP Gupta ji, and that Symphony FinTech, for example, they have this interoperability with this tool. So if you figure out a technical analysis signal on either of these two tools, you could actually have this being automatically executed through Symphony FinTech. So on the Symphony FinTech Presto platform, you could say that if a certain signal is visible on ME Broker or Ninja Broker, then it could directly or automatically send an order to the exchange, and it would manage the orders and so on and so forth. Okay, so so there are platforms available. So because technical analysis is one field which I don't look at, so I wouldn't be sure of the current latest innovations with regards to algo trading for technical analysis. Okay, so coming back to your question, you had a question. Okay, so basically R is very different from traditional traditional programming languages. In a programming language, you need to have a very strong structure. For example, in a C program, you would need to first include libraries, have a main function, within the main function have a, so basically there is a strong structure. You have to follow that structure to write a piece of code in C, C++. In contrast, in R, for example, it's just one statement at a time. So you don't picking it up is way more easier. So understanding a traditional programming language which has its own complex set of complex set of rules and grammar is much more difficult in contrast to programming on R, wherein you just need to you can execute one statement at a time, and then therefore picking up a language like R or Python is way more simpler because you just do it one statement at a time, and uh, if you falter at one particular statement, you can just go to one of the help documents or go on Google and figure out how to do it. So you just execute one statement at a time. So it's way more simpler. Where do you need R and Python? That's more first for analysis, and then some platforms also integrate Python specifically to their algorithmic trading
Is it because
platform,
of
so
the
you can
libraries?
write your code.
Is it because of the libraries which are available, which simplifies the functionality, statistical functionalities, or is it because of the
Yeah, yeah,
community available in Python and R? Because recently there are the community in Python and R are equally growing fast in the statistical analysis community.
yeah. So I would say it's both. One feeds to another and back, right? It's a symbiotic relationship. So because there is a community, there are a lot of packages which are already there. Because there are lots of packages, therefore yeah, if you want to do a complex statistical analysis, now someone else might have filled the requirement earlier and they would have built a package. Now you can directly use that package. You don't have to write your code from scratch, the entire complex logic from scratch to implement it. So therefore now because there are packages, and then because people don't have to do things from scratch, therefore community acceptance grows up. When acceptance grows up, communities build up. When communities build up, people discuss, and therefore languages become popular. So I think it's a very circular effect, wherein A leads to B, leads to C, leads to A, leads to B, leads to C, and so on and so forth. Okay. Hi, Rajendran. What is the typical flow of events like? It's a continuous non-stop 3-hour session, or sometimes you have short 5-minute breaks in
No,
between?
we can have a break, probably a 10 to 15 minutes break, whichever the way we
Okay.
want. Yeah. So
Okay.
generally we prefer
So
breaks.
okay. 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 So coming back to our original flow.
Yeah.
So what is the typical flow of events? First, you
So we can
focus
go through
purely on your
we can go through the slides and learnings, your view about markets. How I mean the basic workflow of the algorithmic trading system, and then we can take a small break, and then we can come up with the questions. People might have more questions, let you continue. Later on, we can take the questions anytime,
okay.
and
Okay.
we can go with the
Yeah, so let me tell you, okay, let me tell you from my personal experience. So there is one, the first session of our EPAD program that we take. So it's supposed to be a 3-hour session with breaks, but then sometimes we get just so many questions, it ends up becoming a 4-hour session without breaks. So let's see how it goes today. Or it's entirely dependent upon participation, interaction with the rest. So how much time we end up spending today.
yeah. Whenever you need a break, we can declare a break, and then we can get back in 10 minutes.
Okay. 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 So someone had a question about cost and so on. So I think that's best done once we have looked at the components. So we would be able to appreciate the cost better, because right now I could just give you cost, but then if you don't know what are the various steps involved in setting up, then it's almost difficult to comprehend. Okay. So someone said We have big threat from other algos which operate from prime location of exchange. Okay, so let me take this question. In algo trading, we have big threat from other algos which operate from prime location of exchange, which gets prices earlier than us, right? Well, not all algorithms have a strong need for time. So, for example, I might have a strategy which could aim to make a certain percentage over a much more longer period. If I'm aiming to make a certain percentage over a much more longer period, then whether I buy now versus whether I buy a second later, the difference in prices that I get might be, so everything depends upon the strategy of the algorithm. So let me explain how. You could possibly, you are aiming for 15% over 1 month. The moment the opportunity arises, the price was 1,000 rupees. 1 second later, either 999 or 1,001. There are 50% probability of the price being 999 or 50% probability of the price being 1,001. So in either case, you would you would end up trading at roughly your original determined price of 1,000. Okay. Now, in contrast, someone who is aiming to do arbitrage, say he's looking at the price of the same stock in 2 exchanges. The difference in stock A at exchange X and exchange Y, if it crosses greater than, say, 1 rupees, then he sells higher and buys lower. But then it hardly stays above 1 rupee. In that case, if he has to lock in the profit, he has to sell at the exchange which is priced higher precisely at the moment when the difference is greater than 1, and buy at the other exchange precisely at the moment the price difference is less than 1. So if they don't do it precisely at that moment, they are never going to lock in a price differential of 1. So therefore, for such people, if there is a delay, the price is definitely going to be less than 1 rupees. Or forget about difference in stock at exchange A and exchange Y. It could be between stock and future price for same stock. If there is a delay, the price difference is definitely going to be less than 1 rupee. So in which case you're never going to have a proper trade. So therefore, for strategies of this type, being fast is extremely critical. For strategies of this type, if you are aiming to hold your positions for 1 year and then whether you get a trade at 1,000 or 1,001, if you are aiming for 50% return over a year and then in a particular stock, or let's say 20% return on whether a 0.1 percentage change in either direction, one is going to be non-consequential. 2, in average, it's not going to matter in either direction. It's even possible that you might have positive slippage. In contrast, there are strategies wherein you have to respond fast to lock in a profit. You said that the strategy buy stock, sells future, where the difference goes beyond X. If you are unable to lock in that profit, so the moment the opportunity arose, because these opportunities are very short-lived, therefore you are not going to have a profit in the strategy. So therefore what it means is, for some strategies the need for speed is extremely high. For some strategies the need for speed is not that high. Because the need for speed is not that high, therefore different strategies are aiming to do different things. The second strategy had a need for speed because the moment this mismatch arose, it would have taken the trade. For the first strategy, it's all about identifying a pattern for the long term and so on. So for the first strategy, the need for speed is not so high. It's about a need for identifying the pattern. It's true in certain senses that if a lot of people are doing the same thing, then the need for speed still does exist. The first person to be able to do the long term, say the entire market is waiting for a breakout at 1000. So the moment the breakout happens, the first person to trade is definitely going to get a good trade. It's true, but often there is a kind of scare in the market. People feel that algorithms at prime location, which is co-location, will be able to respond faster. But then algorithms and co-location are just as clueless, right? So they don't know which way the markets are going to move. So just being closer doesn't help. So there is a lot of scare in the Indian market because people end up reading what's happening in the US market. In the US market, you have the same stock trading in 13 different exchanges, options trading in 7 different exchanges. But more than that, some of the exchanges have given bent over backwards, I would say, to provide certain concessions to people who trade high frequency trading. So they have introduced hugely complex order types wherein someone who enters the market late can still be higher in priority at the same price and so on and so forth. So therefore, some sort of people who understand how to use these complex order types can do better than people who do not understand. Therefore, there is a bit of scare in the US market because some of those naive people get named that way. But then in India, it's just not possible. So a lot of this criticism of high frequency trading that exists in Europe is just not possible. You don't have those complex order types which let people enter late and then so one of the reasons why there is a criticism in the US is you have all those exchange rebates, right? You a market maker, if he buys at 1000 and then he sells at 1000, he would actually make a profit because the exchange pays him for doing all those trades. So you buy at 1000, sell at 1000, you get a profit. So what these guys do is they see that there is a buyer in one of the 13 exchanges. They would buy on all the rest of the 12 other exchanges, and then they would wait for the original buyer to buy at a higher price in the rest of the 12 exchanges. It's just a gamble that they're doing, but then even if the gamble falls wrong, they, at best they can sell at the same price. So what lets them do that? Okay, so that is where the complexity of the US market comes into play. Okay, let me explain that using an example. You on exchange 1, you get a buy trade at 1000. On seeing this, you HFT trader buys at exchange 2, 3, 4 up to 13 at 1000. Now there is a complex order type which allows you, even though you have just entered into the queue, to still be ahead of the queue. So the HFT trader now puts sell orders at 1001 and also becomes at the front of the queue at the based on complex order types. So typically you have price and time priority. At the same price, the first person to enter at that price gets a priority. The second person to enter that price gets the second priority, and so on. But then using complex order types, even though you entered this price late, your sale order is at 1001 is behind a lot of other people who had already put sell orders at 1001. But using complex order types, you can be higher at priority. Now, if the original buyer is genuinely a big buyer, then you end up selling at 1000 everywhere after having bought at 1000. At worst, you would end up selling at 1000. Also, pocket fees. Okay, so because of these two complexities, one, the moment you see a buyer, you buy everywhere, and then you jump ahead of the queue and put your sale order slightly above. If the market truly goes up, then you end up selling higher, buying lower. If the market doesn't go up, you might end up selling at the same price, and then just because you get rebates from the exchange, you pocket fees from the exchange for doing volume. In India, this is not possible. You cannot get to the front of the queue by arriving late. You don't get price-based discounts. So a lot of this criticism that exists in the US for algorithmic and high-frequency trading cannot happen in India. So because it cannot happen in India, so some of these scares are unfounded. Okay. The next question is, what database do we need to prefer the data management? Is MongoDB or any other NoSQL sufficient, or we need to look out for time series database? Yeah, okay, it depends. We have this problem ourselves. So the amount of data that we get from the exchange on a daily basis gets into few tens of gigabytes. Uploading and storing that information on the and then accessing the right data for the right instrument on a daily basis, it's hugely complex and so on. MongoDB NoSQL suffices, or in case of operations where the amount of data is used, for example, in our case where it goes into terabytes and so on, so you might even need to use proper SQL, or like MongoDB or NoSQL, you could probably use MySQL and so on. A lot of people upload the information to Amazon Web Service and then use the Amazon Web Services data analytics tools. So you could do that, and you could also, you could for we personally prefer using different types of databases for different types of requirements. So intraday, for analyzing specific data sets, we just load it on R or Python. Mostly Python these days. R used to be the flavor of the season earlier. So then there are tools like Kibana, KST, and so on and so forth that we use to analyze the data graphically sometimes. Or for analyzing it statistically, we use R Python. For storing a lot of this information, you could use Amazon Web Services, you could use MongoDB, NoSQL, or so on and so forth, or you could just, Do we have any platform to test strategies to do backtesting in R for Indian market and should order after tested strategies? Some algorithmic trading platforms did support interconnectivity with R. So I remember FlexTrade, you could actually feed the market data into the R strategy, R platform, and write code on R, which would analyze the data coming to it from the FlexTrade market data adapter, and then shoot orders from the output of the R program could then be input to the CP in FlexTrade. So on FlexTrade you could do it hypothetically, not hypothetically, practically also, but it's hugely expensive. So the cost of doing this on FlexTrade is huge because the pricing for FlexTrade is very high, few $1,000s a month. Okay. What are the connectivity? Okay, activity requirements for algo. Okay, let me pick this up after explaining the architecture. Next question. Also, sir, are there any classroom programs to learn algo trading? And is there any kind of certification for someone in this field of trading? Oh, that's very interesting. So we have an education business. It goes by the name of QuantInsti, QuantInsti. So I'll show you the website. So it's we provide dedicated course, a dedicated course on algorithmic trading. It's a 4-month course plus 2 months of project work. So the 4-month of course is divided into 3 segments. So we have this international big names, Mr. E.P. Chen himself, and Slippage. Those are the 2 people you saw on the screen. So the course is composed of 3 core segments. The first segment is statistics, basic to advanced. Statistics, so basic to advanced. The next is quant strategies for various asset classes. The third one is the technology angle to it, which is basically working on algo trading platform, working with CPs, complex event processing blocks, working with simulators, backtesting, working with recorded data, and so on. So if you go to QuantInsti.com, you would get to see let me send it to everyone. You'd get to see a lot about this education program. So we have had students from over 40 countries, as I'd already mentioned. Okay. By looking at order book, can we make out whether it's an algo order or not? For the exchange, yes. When you send an order to the exchange, you need to send a tag with the order saying that whether the order has come from an algo trading system or whether it has come from a manual trading system. But as an end trader, you probably will not be able to make out whether it's an algo trading order or it's an order. Trend following or mean reversion, which one is good? Well, whatever makes money for you. Well, for various asset classes, for various statistics, either trend following or mean reversion works. For example, the implied volatility of options. Now, if someone asks you, what was the price of IBM, the stock, or any stock, say, what was the price of Reliance 30 years back versus what is the price of Reliance today? Based on the price of Reliance today, you cannot predict what was the price of Reliance 30 years back. But based on the implied volatility, but you always know that the implied volatility of options is never always going to lie within a range. So some things by characteristic are mean reverting. Option implied volatility is one. Trend so, but then it doesn't hold true. So there is no one formula that works good everywhere. So different thing works in different places. Okay, the next question is, what is code stuffing? Does it frequently happen in Indian markets? Okay, code stuffing is the process of wherein one person, one trading entity would put in a lot of fake orders in a certain instrument, financial instrument, and force others to respond to it, and thereby choke up the resources of the other guy. So I say me and you are trading. I know that if I put in a lot of orders in SBI, in the stock SBI, and then force you to analyze all those orders, and then meanwhile surreptitiously I can do some trades on Yes Bank, because I know that your attention is now focused on SBI, because a lot of orders have been sent on an SBI, and then you're analyzing all those orders on SBI, whereas the intention of those orders was just to divert your attention. So it could be to divert attention if you're analyzing manually, or if it's an automated trading platform, the automated trading platform is going to analyze each and every market data order that it sees. If it's going to analyze each and every market data order that it sees, it's going to spend a lot of time analyzing all the fake orders that I put in SBI, and thereby allowing me to now allowing me to do all my work in Yes Bank, because your platform is now analyzing all those fake orders that I put in SBI. Now the exchanges also realize that such manipulation and such behavior could happen. So what they have done is they have tried to discourage it by putting penalties on people who send a lot of orders without doing trades, and so on and so forth. So and then the regulators in India, are way more stricter than regulators elsewhere. So especially when it comes to algo trading. So sometimes I see very weird behavior in the markets. The price is changing every 100 microsecond. But at a very broad level, I don't think code stuffing happens in India. It might happen, someone doing it in an extremely smart way. I do see some weird behavior on some days on stocks which are not hugely liquid, wherein I see a lot of orders sent one after another by the same entity every 100 microsecond, changing the prices every 100 microsecond, and so on and so forth. But at a broad level, I think the markets are places we can have confidence in. Okay. The next question: what type of algo strategies are suitable for retail traders? Say IV-based orders, delta dynamic. Considering the fact that we don't match the big boys in terms of speed of execution, execution costs, infra, etc. Okay. And I think there is a similar question. I trade 100 lots of Bank Nifty in intraday trading. What are the best ways to place such large orders in order? Okay. For retail traders, delta dynamic, because your costs are high, you should not be aiming for very small profits. Therefore, you should be aiming for more more predictive models which aim for bigger profits. Because if you're trying to execute strategies which aim for smaller profits, then the amount of leeway that you have is very less, because you are going to pay a very high cost. So if you are aiming for 10 paisa of profits when the cost of execution is 5 paisa, you only have a 5 paisa bandwidth. But if you are aiming for 35 paisa, the 5 paisa pays in comparison. So therefore, you are much more comparative. In contrast, if you are aiming, if your competitor just has 1 paisa of cost, in that case, he can keep doing the trade at 5 paisa, and then you will never get to do the trade at 10 paisa. But if you are aiming for longer dated, longer holding positions, in that case, you are not restricted by, for longer holding portfolio strategies, the liquidity is often never a constraint. So the constraint is getting the longer dated view correct. So if you can get your slightly longer holding view correct, then liquidity is never a constraint. So you just you can get what you are aiming for. But if you are aiming for strategies which aim for extremely small profits, in that case, because you are competing with automated trading platforms, we are also trying to do the same. Therefore, it could be difficult. Okay, coming back to the question, I trade 100 lots of Bank Nifty in intraday trading. What is the best way to place such large orders in automated way to get better prices? Okay, so have you heard of concepts like execution strategies? Time weighted average price execution strategy, volume weighted average price execution strategy, implementation shortfall execution strategy, and so on. So basically what these execution strategies do, they try to slice and dice all your orders into smaller orders, and then ensure that your big orders do not get noticed by others as you trade on the market. So they would slice your small orders into a lot of big order into a lot of small orders, so that no one else would realize that you are trading in the market, what you are doing in the market. And based on your sliced and diced orders, they could then basically the algorithm will break down your 100 lots into one lot at a time, and then it would surreptitiously just keep putting your order somewhere in the top 3 of the order book, ensuring that you don't pay slippage or the big bid-ask spread to the market. So it would keep aiming to do one trade every 5 minutes, or match the VWAP in a 2-hour time frame, and so on. So there are lots of execution algorithms that exist, TWAP, VWAP, etc., which aim to break down your orders or big orders into a lot of small orders, and then keep doing trades slowly and silently in the background. So you could use one of those execution strategies and so on. Okay, so let me do one thing. As advised, let me take a very quick break, and say of 5 minutes. And once we're done with 5 minutes of break, we can again reconvene.
Sure, then we can get back by 11:55 a.m. sharply.
Okay, 11:55. So let me put this on this screen also. Time.is. When it becomes 11:55, we will reconvene.
Yes, exactly.
Okay. So I was just going through our educational website, QuantInsti.com. I see that it actually has a very relevant blog on setting up an algorithmic trading desk. So what I was actually mentioning now, what I was going through, I was discussing this part all this time. So this blog actually very nicely answers a lot of the questions that most of you could have. So for example, it actually elaborates the flow of steps involved. So registering and setting up an entity, which involves you would have to take up a director's identification number, create an entity, register with yourself with Ministry of Corporate Affairs, and if you want to become a entity registered with SEBI, then you have to do that also. or else you could just partner, or you could just partner with, if you are not planning to do it in such big scale, you could partner with a broker who already does it, or if you're planning to do it at an even smaller scale, you could use Kite APIs or interactive broker Python APIs and so on and so forth. Okay, so once you have decided your trading strategy, so the next thing you need to look at is what kind of algorithmic trading platform exists which can fulfill the requirement for your strategy. So, so this is one diagram that I had made quite a few years back. So it's interesting to see someone else has modified it slightly and then done it, enhanced the look and feel of it. So this is what a traditional algorithmic trading, this is what a algorithmic trading platform looks like, and this is how the architecture of a traditional platform looks like. A traditional platform, you get the market data onto your trader's tool. The trader will have to look at the data, make his trading decisions, and look at the data, look for patterns in the data, and make his trading decisions, send orders to the exchange via the order manager, and so on. So the data flows all the way to the trader's machine, goes all the way from the trader's machine to the exchange. In contrast, this is how it happens now. Oh, I think this is where the flow got missed. So current, a modern day automated trading platform, this is how the flow is. The data grows from the exchange to a market data adapter. So what is a market data adapter? So the exchange provides data in a format that the exchange understands. But then your trading system is built in a different way. So it is designed to understand what the bid is, what the price is, ask is, what the, and so on and so forth. Now, the moment you connect from to 5 different exchanges, your internal system from here onwards is going to be the same. The internal system is going to be the same. So what you do is, the moment you get data from different exchanges, you denormalize it. You convert it into a normalize it rather, and you convert it into a same standard format. After you convert data from multiple exchanges into the same standard format, the data then goes to a CEP block. In the CEP block, what you do is it applies the trading logic. It listens for events. It says a complex event processing engine, right? So it is listening for complex events, and then it processes those complex events by doing what it is advised to do. So it gets market data. The market data goes into the CEP. The CEP, when it gets a complex event, when it sees a complex event in the market data, it reacts to it. It reacts to it by sending out orders. The orders are then fed into the order managers. These links are missing, so whoever copied my diagram missed out a few of the links. Okay, so it goes to this order manager, and the order manager then does, before sending out the order, it will do all this risk management checks. So all these risk management checks, what are the risk management checks that you could possibly have? You would have things like the size of the order, the value of the order, the net number of trades that you have done, the total portfolio value, the portfolio delta, vega, gamma, theta, and so on and so forth. So it would do all those risk checks, forward it to the order router. Why do you need an order router? Because you might be sending orders to multiple exchanges. Because you might be sending orders to multiple exchanges, you have the order router, which then sends it to the right exchange. So this is a typical flow, a very simplistic flow. Now, the complex event processing block, you feed in instructions saying that whenever event A or event B happens, I need to send out. Am I audible to everyone?
Yes, very much.
Hello?
Yeah, you're audible.
Okay.
Yeah.
Okay. So So this is a typical flow. You get data from the exchange, you need to convert it into a structure that the rest of the system understands. You have a complex event processing block which listens to the market data and tries to figure out if certain patterns have occurred. If certain patterns have occurred, what should the system do on such event? If it has to send an order, it sends that request to the order manager, which does the risk management check, then routes it to the right exchange. Okay. Now, within the CP, you have to set patterns, saying the instructions saying that whenever event A happens, whenever event B happens, you need to send out orders. Now, how do you do that? You use the application block which exists on the trader's machine. So here you set the application's strategy parameters. You said that, okay, whenever event A happens, which is say difference between stock and future going over 5 rupees, sell future, buy stock. And whenever the difference goes below 3 rupees, buy future, sell stock. Okay, so and never go over net position greater than 1000 or something of that sort. So that is the strategy setting that you set here, which then gets implemented, applied on the CP. To be able to set the right parameters, you need to know, get the feedback. How do you get a feedback? You need to know what is the P&L so far. Are you making profits? Are you accumulating positions in one direction? If you're just accumulating positions in one direction, probably you are too aggressive in one direction. What is the number of orders that you have sent versus what is the number of trades that you have done? If you have sent 1 million orders and then you have done just one trade, probably your parameters are not optimal. Versus if you have sent, say, 1 million orders and you have done 990,000 trades, then also it means that probably your orders are, strategy parameters are too aggressive. Dedicated maths calculations, you might want to do it in a GPU, for example. So people who have played computer video games, for example, you know that computer video games need to do a lot of calculations to fast-moving graphics. To be able to do all those calculations fast, instead of doing the calculations on a CPU, which is designed to do everything that a computer needs to do, all those maths-intensive calculations are offloaded to a GPU. The maths calculations are offloaded to a GPU. Now, graphics processing unit, which is designed only to do maths. Now, if a GPU is designed to do maths more optimally, now, what is one other field which needs a lot of maths calculations? It's finance. It's trading. So because trading involves a lot of calculations, the CEP could instruct the maths calculation block to do a lot of these calculations and feed it the answers back to it and so on and so forth. So therefore, you have that. Now, as I mentioned, third-party analytical tools like R, Python, MATLAB, etc. Some platforms allow you the ability to send data from the market data block to R. Then R could then directly instruct to send an order, or R could be used to set a strategy parameter based on the market data, historical market data, and so on and so forth. And currently, some of those CPUs you could actually implement using Python. So I think Kite by Zerodha has a lot of Python related, is based on Python, if I'm not wrong. Interactive Broker is Python based. So you could do that. Okay. What else do you need in an algorithmic trading platform? What else do you need in an algorithmic trading platform? Okay, so basically what you need in an algorithmic trading platform is the ability to, when you build a strategy, okay, let's go back to our first, yeah. When you're building a strategy, you made a hypothesis. You then try to validate your hypothesis by analyzing statistically. Then you made your decision whether you want to trade algorithmically or manually. Say your decision was to trade algorithmically. What do you do next? You implement strategy on algorithmic trading platform. But you know what is the lacuna here? The strategy hypothesis was built by someone who understands the market. And the strategy has been implemented on an algorithmic trading platform by someone who is a software programmer. So this is done by a trader slash researcher, and this is done by a programmer. You don't know whether the implementation was correct. So the trader might have said buy when event day happens, and the software programmer might have implemented a sell. Or probably the code doesn't work when the price goes above 9,000 or something of that sort. So what do? You don't track your strategy directly live on the exchange. What you do is you first test it on fake exchange, so which is the simulator exchange. So instead of sending orders to a true exchange, you run the same system and send orders, direct the same orders to the simulator exchange. So the orders go to the simulator exchange instead of the true exchange. You get reply back saying that whether the order got executed, acknowledged, and so on and so forth. And it also knows what the current market data looks like. So based on how the market data looks like, it tries to simulate the behavior of the true exchange. So the better the simulator is, the faster and easier and smooth, more accurate is the process of building an algorithmic trading strategy for you. So you see, if the simulator can replicate the behavior of the market, then you just code your strategy, run it against the simulator. The simulator says that you made money on the day when the market was robust, on a day on volatile, on a day when the market was boring, on a day in which the market was going up, and blah blah blah. The strategy, you run it on the simulator for 13 various types of dates. It makes money on 30 different dates. Then you know that it's a good strategy and you can go live. So therefore, having a very robust simulator is very important. Now, in fact, a few years back, I was invited to speak at a conference in Chicago, and then there was another speaker there. So the speaker was, he worked at the largest high-frequency trading firm in the US, and then he had been spending 7 years building the simulator. He spent 7 years just building a simulator, and because he had spent so much time building the simulator, making it as close to real life, therefore he understood the market so well that a year after that, in fact 6 months after that, he became the head of equity trading at the biggest high-frequency trading firm in America. So therefore, having a good simulator is very, very important, because it helps fasten your go-to-market lifetime life cycle. It helps you test strategies very quickly. If there is a bug in your strategy, and then say it, you would immediately see it in the simulator, because your simulator will show you that you are making losses continuously throughout the day. So having it.
When it comes to Indian markets, do we have to build our own simulator, or any third-party tools are available for simulators?
Okay, so a lot of this algorithmic, that's a very good question. So a lot of these algorithmic trading platforms come with their own simulators inbuilt. So they have their own simulators inbuilt, but they provide you a very basic simulator. Now you have to work on that simulator, enhance it, fine-tune it. There are people who have built a lot of enhancements to simulators. I'm not sure if a lot of this simulator making it close to real life, if those codes available in the public domain as open source or so on and so forth. But a lot of these platforms come with their own simulators. But the disclaimer that I have to give is a lot of them are very simplistic. So they are not probabilistic fills. So your own order will impact the market and so on and so forth. And then what happens when you put an order between the best bid and the best ask? What is the probability of getting a fill, and what percentage of... it's easy to simulate medium frequency strategies, because if you send an order deep into the order book and hold a position for 10 days, it's very easy to simulate that. But then if you're trying to simulate the behavior of the marketplace as you send orders at the top of the order book, dime the best bid, dime the best offer, you don't know how the rest of the market would respond to that. So you have to make somewhat probabilistic simulators and so on and so forth. And that is where people's understanding of the market microstructure comes into play. How well you understand the market. The better you understand the market, the better you can implement a simulator. The better you can implement a simulator, the higher, the better you understand the market, and therefore you end up becoming head of equity trading at the biggest high frequency trading firm. And okay, so it might look very scary to a lot of you that well, a simulator, having a good simulator is very productive. But if you have to build it from scratch, isn't it very depressing at the onset itself? Well, there are people who also offer simulators as a service. So, for example, I know Symphony FinTech used to offer simulators as a service. So, I think they still do. So, they have an, you could, or even the NSE, National Stock Exchange in India, they also offer a simulator as a service. So, they have their own logic which tries to simulate what would have happened. So, every day in the evening, they replay the same day's data. And you can connect to the exchange, and then they will try to then simulate if you had sent orders to the exchange, sent orders to the exchange based on the state the current replay data is. So say they are replaying data from 9:15 and right now it's 10 o'clock in the simulated replay data. You send an order. So the best bid, best ask is 100 best bid at 100.15 best ask, and then you put an order at certain prices. So the exchange has a simulator logic which tries to behave close to what the real market would have behaved if you had sent orders that way. So the exchange provides one, Symphony FinTech provides another, and I'm not sure of others. So this globally sophisticated platforms, if you buy, they have their simulators which wherein they have programmed a lot of complexity, so you could try looking at those also.
Okay. So, and could you please explain the data normalizer? What is the role of data normalizer in the market data block?
Okay, so basically different exchanges would provide data to you in different formats. So the data normalizer just converts, normalizes data into a standard format for the rest of the system. The rest of the system might be designed in a certain way to understand data in a certain way. But the exchanges, they have been built in their own independent ways. So the exchange would build it in their own way. So this is basically converting data into the standard format. Okay, so once you implement, does that understand? Sorry, answer your question?
Yes, yes, very much. Yeah.
Okay, so once you have implemented your strategy on an algorithmic trading platform, the next thing is therefore testing it against a simulator. Now, once you have tested it on a simulator, well, if you have the ability to test it on a simulator, that's not all. Because say you figure out a shortcoming in your strategy, or you figure out an enhancement to your strategy at after the close of market hours today. Now, if you can test it on a simulator, you make changes to your strategy, and then you wait for the next day market to open, and then you change the configuration so that the orders go to the simulator instead of going to the real market. You could do it that way. But if you also have a store of historical market data, then you could actually replay that historical market data to your system and simulate yourself against that historical market data. If you simulate yourself against that historical market data, in that case, what happens? You make a hypothesis at 4 o'clock after the market closes. You make your code change. You test it against replay historical data and test your new implementation against historical data at 5 o'clock. Everything seems good. The next day morning, you are good to go live with the new modified enhancement. Or plus the good thing is you can replay data for various types of dates. You can say that, okay, let me replay data for a day on which the market was hugely volatile, on a day on which the market just continuously kept going up, on a day on which the market just kept going down, on a day when the amount of volume was high, on various types of day. Or you could replay for one full calendar year, one day at a fast pace, and then you could see how your strategy would have behaved against all types of historic dates, and then that gives you confidence about the strategy. So being able to replace stored historical data back into the system, that is another feature that you are going to look at. That is good to have when you are evaluating a platform. Replaying historical recorded data for various types of trading days. Okay, so then a lot of this, how do you get confidence in your system if you cannot see the state of your system? So, because a lot of these things are like a black box, right? You get data from the market, it looks at patterns within the data. When it sees patterns within the data, it requests the order manager to send out orders. The order manager then sends out orders to the exchanges. But everything is happening internally. You get to see orders, executions, state, and so on and so forth, but then you might have 10 different traders trading parallelly and so on and so forth. Each trader would see his own. So you also need an admin terminal which shows you a global view of what the state of the system looks like, the total number of orders that have gone out, the total number of trades, the number of trades per second, the number of the order to trade ratio, the health of the system in terms of processing time that it's taking, the amount of data flowing into the system, whether the amount of lag in the system, and so on and so forth. So you need an admin terminal which gives you confidence that it gives you a peek inside the order manager, and therefore gives you confidence that the system is working fine. So another tool that you would need is that is good to have is the admin monitor. So basically, looking at this diagram, what you realize is what are the different ways in which various algorithmic trading platforms could vary from one to another. So therefore, this tells you how to compare different platforms for features. So whether it allows interoperability with R, Python, MATLAB, etc. Whether it has a simulator, how robust is the simulator, whether it allows you to replay historically stored data, whether it provides you an admin terminal, and what is the level of sophistication of the admin terminal, whether it provides you a kill switch from the admin terminal. So if you see that things do not look good from here for whatever reason, you should be able to kill all trading from here immediately. So whether it gives you a kill switch, and yeah, so these are some of the factors which you need to look at when you are comparing different algorithmic trading platforms. And then within CEP, what is the level of, how easy or difficult is it to code it on the CEP? Do they have pre-built functions, or do you have to code each and every trading logic from scratch, or do they already have pre-built functions for, say, DMA, moving average, or implied volatilities, or blah blah, and so on and so forth? So what is the level of support already existing? How easy or difficult is it to code your type of strategy on the CEP? For example, your strategy might have something to do with technical analysis. If the CEP is designed for high frequency trading, then yeah, it's like trying to marry a horse and a tiger, so it doesn't make sense. So that is what is going to happen. A horse is great for certain type of tasks. A tiger is good for certain other type of tasks. You can't marry both of them, so you have to take care of the same. Okay. So that was the thing on algorithmic trading platforms. The latency, the sophistication of the platform determines the cost of the platform. What is the kind of latency that it has versus what is the kind of robustness that it has, and feature rich that it is, and likewise will be the cost. So that is it. Once you have decided on your algorithmic trading platform, then you have to decide on the infrastructure. So within infrastructure, if you are doing it, if your need for speed is not high, then you could just have a guide Zerodha or a interactive broker API connect, or if you want something which is slightly more robust, your own dedicated server instead of sending it through the server of, say, one of these brokers. If you want to have your dedicated server so that you get to respond immediately and so on and so forth, you could talk to a broker, work with a broker, and put your server at a broker. Once you do that, and then if your need for speed, etc., is even more higher, then you would need to set up your server at colocation. So what is colocation? You would then need to, this is basically a feature the exchange provides, wherein they say that you can put your servers at our premise. So the total flow of data is from the exchange to the server. The server resides on colocation. The market data normalizer within the server market data blocks is on the server. It goes to the CEP, which is again on the server. The CEP then forwards a request to the order router, which is again on the server, and the order goes to the exchange. So everything is from the exchange to the server to back. Traditionally, it would be from the exchange to the server to the trader's machine and back. So therefore, physically, the data had to travel all the way to the trader's machine. But now, because all the decision is being done on the server itself, therefore, if you can put your server on the exchange, the amount of physical latency, the physical data transmission latency reduces drastically. Therefore, you could respond way faster to events, and therefore, people saw a great potential in putting their servers as close to the exchange. So the exchanges also realized a big business in offering space within their space. In fact, exchanges these days are moving people outside of their exchange building and then using the same space for co-location, for putting up servers. So, and then people are being forced to move out to other buildings where the old traditional exchange building have become places for just putting servers. Okay. So once you have done that, next you have to decide on hardware, what type of servers you want. So everything again then depends upon the kind of latency that you are looking at. So if your need for speed is high, then you would probably want to even have sophisticated network interface cards like SolarFlare, Exablaze, and so on and so forth. Now, if you are having your own setup, what sort of network setup you would need? So you would need one trading line. So from sending out, so basically sending out orders from your server to the exchange. Now, which is this, sending out orders from your server to the exchange. Now, the cost of sending out orders from your server to the exchange is determined by where your server is, but more importantly by the number of orders that you send per second to the exchange. So various exchanges have various schemes. So I'll give you a very popular scheme that exists at the NSE. So in NSE, if you want to send 40 orders per second, you don't have to pay anything extra. But if you want to send 100 orders per second, I think you have to pay 2.5 lakh rupees per year plus service taxes. If you want to send 200 orders per second, you have to pay 5 lakh rupees a year plus service taxes. If you want to send 400 orders per second, you have to pay 10 lakh rupees plus service taxes. So that is the cost of sending orders to the exchange. Okay, the net trading list line. Then you have the market data list line for getting data from the exchange to you. Earlier, when the tick by tick data used to be a dedicated TCP connection, then you had to have a dedicated TCP connection to the exchange. So each tick by tick line was 1 lakh, but now it's provided using a UDP connection, so broadcast tick by tick. So in which case, for the entire rack, you would need one connection, which is 1 lakh in case of NSE. So there are two formats in which data could come to you. One is the tick by tick format. The other one is the snapshot. And then there are various variations within it. In case of tick by tick, okay, let me use this uni board. So I don't have the writing pen. So if my handwriting is not very clear, just pardon me for that. So in case of tick by tick, so if someone puts in so say this is how the order book looks like. These are the different sellers, and these are the different buyers. Now, suddenly someone puts in a buy order here, you get this information.
So all these are resting limit orders, right?
Yeah, these are resting limit orders. The moment someone puts in a buy order or a sell order, you immediately get that information. So that is TBT, tick by tick.
Mm-hmm.
In contrast, you have the snapshot, wherein once every X time frame, the exchange would provide you a snapshot of the top and best bid and the top and best ask and the top and best bid. So here they would say that once every second. I'm hearing my own echo, I think. Yeah. So once every second, in cases of the currency segment, you get to see how the top 5 bid and the top 5 asks look like. So pardon my handwriting because I don't have the pen right now. Okay. In case of the FO segment, it's every 1/4 of a second you get the snapshot data, which is the top 5 bid and the top 5 ask every 1/4 of a second. And there is a third, so this is snapshot. Okay, the third one is now in case of TBT, what do you have to do? Every time an order enters the limit order book, they will give you that order. So the number of data packets that you can get in a second is like thousands, hundreds, tens of thousands per second or even more. So you get a lot of these individual orders, and then you have to form your own order book on your own. In case there is a fault in your system, you might not have the right order book.
How many levels generally exchange gives? Probably for 20 levels of depth of the markets.
In case of snapshot, I'm not very sure. So 5 for sure, probably it could be 15 also. But then in case of tick by tick, they will give you each and every tick, anywhere it happens in the order book. Because if the market moves and then you did not know that a certain order was resting at a certain place, then you would not have the true picture. So in case of tick by tick, they would give you each and every tick anywhere in the order book. So even though it might happen like if you 10 percentage points away from the top of the order book, they will still provide you, because in tick by tick they provide you everything, because you have to build the order book yourself like the exchange does.
Okay, so then in that case it is recommended to go with a synthetic order book, something like sort of, we have to build our own order book.
You have to build your own order book. Okay, so you have to build your own because the exchange provides you all data points, you have to build your own. Now you might have some errors while doing that. So what the exchanges do is there is a middle part. So what they do is they provide you a snapshot of TBT. So they say that every time something changes within the top 10, top 15, I'm going to send you. So I'm going to send you a snapshot, but not once every second or once every 1/4 of a second. I'm going to send you a snapshot at any point of time whenever the top of the order book changes. So that's the third. So snapshot of TBT snapshot is what you could say. Snapshot whenever top of order book changes. So instead of time-based snapshot, you could have activity-based snapshot. So one is TBT, the second is snapshot, time-based, the third is snapshot whenever activity happens at top of order book. Okay.
One has to have a clear idea about the market structure, market microstructure, to understand the order flow concepts, to understand the liquidity, where the liquidity we can get, right? So a very strong knowledge on market microstructure is required. So what are the books you recommend to study on market microstructure or order flow stuff to understand the liquidity exchanges?
So there was this very interesting slide that I had made. So slide share, literature review. So it actually lists good books on different topics within algorithmic trading. So for market microstructure, for example, it says that the book by Larry Harris is a good read, and then you could also read the book by O'Hara. So likewise, it says that for algorithmic trading and strategies, what are the good books to read? Books by Ernie Chan, for example. Then for technical analysis, these are the books which a friend of mine, a strong, successful trader in technical analysis, suggested. Books in quantitative trading, books in options trading. So especially being an option trader for so many years now. So these are the easy first reads. These are some of the more sophisticated reads. So this is how I have suggested that people should be reading on options. And then you have portfolio management. So you can go through this, you can search for, or let me just copy paste and share it with everyone.
Yeah.
Where is the chat? Did it?
Yeah. Got
Did
that.
you guys get it?
Yeah, got that.
Okay. Yeah. Okay. So yeah. So it depends on your requirements, because if you're looking at implementing tick by tick, it's usually complex. So you have to implement all the features of the exchange, all the nitty-gritties, all the various order types, and so on and so forth. Snapshot is easier to use, and so on and so forth. You get the top 5 bid and ask every second, so it's much more simpler. But if you're using a tick by tick, you actually know where each and every order is residing. You could actually, it's not easy. A lot of people try, even the best high frequency trading firms don't have great data visualization tools and then tools to figure out where people are residing, because the amount of data is so complex. So, but theoretically it's possible, because you know where each and every order lies.
One tool is there, Bookmap. I think Bookmap. If you heard about Bookmap,
yeah. So just the other day, I was looking at Bookmap. It's really a good tool. So they were a high frequency trading firm themselves, and then they had this requirement. So therefore, they built it themselves. So Bookmap is a great tool for visualizing tick by tick data. Yes, that's definitely for sure. So yes, if you use tick by tick, you actually have the entire order book, so that you can actually figure out where people are residing and so on and so forth. But it's a complex complex science. Okay, so that is there. So the market data that you get could be of different formats. So you would need a lease line to get market data. So now the tick by tick data is UDP, and then this is also UDP. So you just need one market data lease line per server rack. Earlier you required one TBT market data line per server. So the costs have come down. If your strategy involves trading between exchanges, then you have to have the lease line between the exchanges. The fastest lease line between NSE and BSE is now very expensive, very, very expensive. Plus, I talked about exchange providing you an exchange simulator and so on and so forth, right? So, okay, yeah. So the exchange providing you exchange simulator and so on and so forth. So to be able to send orders, to the exchange test market and so on and so forth, you would need a connectivity to the exchange test market. So, sorry. So this connectivity, I think, is around 1 lakh rupees a year. So you need to connect to this as well. Okay. Okay. So let me now come to the process of going live from a compliance and regulatory perspective. Okay. So first, you have to execute your trading strategy on an exchange simulated test market. So exchange simulated test market. The next thing is you have to also execute your strategy on a mandatory mock trading day. So I'm going to explain the differences between all of them. Trading day. Then you have to get it audited by an auditor and give a demo at the exchange. Demo of risk management aspects. Once you do that, you get an approval from exchange to trade the strategy, in which case you would, once you get the approval, you have to apply for all IDs and so on and so on. Then you can go live. Okay, so what is the exchange simulated test market? Remember this test market that I was discussing? So the test market provided by the exchange, the simulated test market provided by the exchange. So you need to test your, execute your strategy on the simulated test market, provide proof of doing that. So proof of doing that via screenshots and logs. Likewise, there is also something known as a mock trading day. What is a mock trading? So basically the exchange is open on Saturdays. On Saturdays, you can send orders and then others can send order, and then people, your orders will interact with orders sent by others, and then there could be trades and so on and so forth. Now, every Saturday there is a mock trading. Basically you trade, but it's a mock genuine, right? So you trade, but these are not genuine transfer of money and transfer of shares and so on and so forth. But your orders interact with others' orders. So there is this mock trading happening on the first Saturday, on every Saturday. And the first Saturday, it's mandatory for everyone with an algorithmic trading system to participate in the mock trading activity. So if you want to trade your new strategy on the exchange, you have to participate with that new strategy in the mandatory mock trading day and send orders to the exchange using the using your strategy on mock trading day. So once you do that, you provide proof to the auditor using screenshots and then the logs. They would verify that whether it actually participated in the simulated test market and whether it participated in the mandatory mock trading successfully. If they are satisfied, they would provide you with an auditor certificate. Earlier, it used to be a list of auditors that the provided by the exchange. I think now it's they have relaxed that requirement slightly. Once this is done, once you have the auditor certificate, you go to the exchange for a demo. You have to apply for a demo date. So the exchange will tell you on what dates they have a free slot available. Based on dates on which a free slot is available, it would invite you, and then you have to demonstrate your strategy. But the exchange is not bothered about the strategy per se. They are mostly interested in looking at your risk management features of your strategy. So they typically have a checklist of NSE risk management. So they have a checklist of around, let me say, MWPL. So it's a list of checks that they have. So not this one. So it's a list of checks that they have, and then if your system works good against that list of checks, then you get the approval. So and once you get the approval, you have to apply for IDs. You have to convert those neat IDs to apply for IDs, then convert neat IDs to CTCL IDs, which is computer to computer link IDs, which is automated trading IDs. So once you do that, after that you can go live. So that is the typical process of trading, getting the approval to trade your strategies on the exchange. Okay. So
if someone want to have an CTCL ID, they need to have a dealer license, right? So they need to complete equity derivative exam series 8 by NASM.
Oh yeah. So you also need certification. So first you need to have a neat ID. So for which I think you need to have the NCFM certification. Once you have the certificate, you have the neat ID, then you need to convert them to CTCL IDs to be able to trade algorithmically. So that is the next step. And once you do that, you also need to map your ID to the approved strategy name. So you could have 10 different strategies approved in your name, but then you need to say that on this date, what strategy are you executing? Okay, so you need to get that approved. You cannot be, you cannot have one option trading strategy approved and another cash trading strategy approved. And right now, if your cash trading strategy, the equity trading strategy is mapped to your ID, you cannot trade the option strategy today. So you have to change the mapping. That is one day. You have to do it before, I think, 1:30 for the changes to be applicable the next day. So if you, so there is this loss of one day if you would not do it on the right time and so on and so forth. So once you do that, you map your ID to the approved strategy name, you can go live. Okay, once you have gone live, what are the things that happen? You need to keep a store post go live. So once you go live, what are the steps? You need to keep order log for I think 6 years. I'm not very sure. And years. Then you need to keep all strategy parameter log again for n years, I think, which is 6. So you need to keep a record of all your all activity that you have done, so all the orders that you have sent, all the parameters that you have set, the reason why the orders went out. So you need to set all your parameters, record of all your parameters for n years. Then you have the audits.
How frequent the audits will be from the exchange?
Yeah, so you have the exchange audit, the SEBI audit. So there is one annual audit, there is one 6-monthly audit. So yeah, you have two different audits.
Okay.
So you have the audits from SEBI, you have the audits from on the exchange. Yeah, so these are two more tasks, regulatory tasks that you have. So that is with regards to conformance and empanelment plus audit and compliance. So you have to maintain order logs, trade logs, control parameters for past few years. So
if someone is a retail trader, so is it it's a broker's job to maintain all those things?
Okay, so if you are sending, yeah, so coming back to an original question, so can you, as a retail trader, send orders algorithmically? I think it's a gray area because theoretically you have to get your strategies approved. You need to platforms like Zerodha and Interactive Broker, if they are providing Python-based APIs, there is a lot of debate and confusion whether it's actually how much of it is allowed, legal, and so on and so forth. So there is a bit of confusion. I'm not very sure.
So far, I think the semi-automatic is what legally allowed by the exchange and SEBI, and the dealer can execute fully automated strategies or execution methodologies.
So for retail, there is, yeah, so as you mentioned, it's a bit of, yeah. Okay, so now going back to some of the questions which I said I will take it after we had discussed the architecture. So one question is, what are the, okay, let me change the format. What are the connectivity requirements for algo HFT? Do we require 20 BIDAS? What data provider gives 20 BIDAS for retail level HNI type client? It depends upon your strategy. How much data does your strategy need? Now, in case of snapshot, we have already discussed snapshot. So in case of snapshot, you don't get 20 levels on either side, at least in India. So it would depend upon exchange to exchange. So in India, you don't get 20 levels on each side. So in case you are listening to tick by tick, you can have the entire world. So if you are listening to tick by tick, if your strategy requires 20 levels, most strategies don't. It's an overkill. If your strategy requires 20 levels, then you can use, you would have to use tick by tick. Okay. What are the hardware requirements for retail trader to do algorithmic trading? If you use Kite or Interactive Broker, etc., you don't need anything because the server resides with the broker. So you just need to code your strategy, remotely connect to the server. So it's even encapsulated from you. You don't even know that you are remotely connected to a server. You just connect to log into your account and then access your CEP block wherein you write the code, and then the code then goes and resides at the exchange server. So if you are doing it in a slightly more scaled up fashion, in which case you are tying up with a broker and then putting your servers at the broker. So in which case, so you could actually use existing server space with the broker. So the broker could say that, okay, hey, listen guy, I already have this server with me, so why do you need to buy a full new server for your requirements? So they could share server space with you. So it again depends upon the kind of sophistication. The servers that you need would again depend upon the kind of strategies that you have. So for example, the kind of servers that we require versus the kind of servers that you require might vastly differ. So in our case, probably one server could have hundreds of portfolios, in which case if it has hundreds of portfolios, you might need a huge number of cores per use per server. But then in case the strategy, your strategy is just one big portfolio or a very few number of, or you are okay with slight amount of delays in processing, then you don't need such configurations, huge number of CPUs per server. So the hardware requirement is a pure function of the kind of strategy that you have. If you are a pure retail and then you are going via zero-DA, interactive broker, etc., then you don't even require a server. You just need an internet connection to your account to be able to code on your account, the CP allocated for your account. I've already answered this question. Okay, so when we talk of slippage, what it's compared with? Is it VWAP or mean of bid? Any standard being followed? Well, it would depend on person to person on what basis, what matters to them. Standard is the VWAP. But if you're looking at high frequency level, then for us, it is bid ask. For medium frequency strategies, most execution strategies use VWAP, but then for high frequency strategies, looking at information at a tick by tick level. So whether we get to do the trade at tick X or tick X plus 1 or tick X minus 1, that makes a world of difference. And then we do huge number of trades per minute. So therefore, for us, it's bid and ask. For longer holding period, lower latency strategies, higher latency strategies, sorry, lower frequency strategies, it would be VWAP. Cost of the setup for algo trading platform. If a person does not know, okay, I already discussed this part. Is there any service? So I mentioned Symphony, Fintech's robust setup of all these programmers and so on. There could be others. I'm cognizant of one, so it's not like I'm advertising one product or one set of people. It's just that I am aware of one. There could be others. Cost of the setup for algorithmic trading platform. It depends. So if you are buying a prepackaged, if you are buying a prepackaged strategy, in which case you don't get the CP, you only get to see the application, and you can't code on the CP. So they will code a straddle strangle option straddle buy, option straddle sell strategy to you. Yeah, for such, I think, I'm not sure, probably single digit 1,000 rupees, less than 10,000 rupees, that is. It could even be 2,000-3,000 rupees a month if you're buying a huge number of licenses. But if you are buying the entire platform, the CP itself, and then the platform can support a few million orders per day, and it can respond to events in single-digit microseconds and so on and so forth, then the cost will be in few $1,000 a month, even for trading in the Indian markets.
Okay.
I already discussed this collocation. What is the connectivity requirement? Do we require? Okay, this was also discussed. Okay, let me now look at the possible new set of questions that we might have. Where is this? Where is the chat box? Okay.
Let me put out the question. There is a question from one of the broker side. So he's a broker. His question is, what are the parameters one need to consider for HFT trading? For example, the Sharpe ratio or the car over MDD, the car MDD or the Kalmar ratio. So he's talking from the strategy perspective. What generally HFT traders look out for when it comes to the trading strategy performance?
Okay, so basically, there was a very interesting article the other day. Someone said that all trading is now HFT because everyone who buys in big, everyone who is buying, doing big volumes, if they have to buy huge amounts of volume, they would use an execution algorithm, TWAP, VWAP, etc. And then the latencies of all of those are so less. So in a sense, all trading is HFT. That was an extreme statement to make. But then if you have a prop trading HFT strategy, so in prop trading, high frequency trading strategies, either it should keep making money every. So Sharpe becomes a difficult. Okay, so in HFT, traditionally, you know what a good Sharpe ratio number would be. Say anything above 1.5 is a good Sharpe ratio for a strategy. But with the advent of high frequency trading, people started reporting extremely high Sharpe ratios. They would say that, hey, look, my strategy has a Sharpe ratio of 20, 30, and so on and so forth. But the mismatch lies in the fact that Sharpe ratio is return, excessive return by standard deviation. Now, excessive return, traditionally, traders would calculate the return of their trading strategy, which is money put in the trading margin account, trading profits realized. But with high frequency trading, the returns are generated not because of the margin money, because in high frequency trading, the positions are very small. You buy, you sell, you buy, you sell. You don't ever have, you try not to have big positions at any point of time because your positions are never big, so your margins are small. If your margins are small, therefore your trading returns are very high, and then you can then report an extremely high Sharpe. So Sharpe for high frequency trading
always pretty low, right? So you want to say something like that. The drawdown is always low, so the Sharpe ratio will be always high.
Yes, that is also another way. The volatility could be high. The drawdown is low, so but the volatility could, yeah. So the Sharpe ratios are high. One, because the margins are extremely small. The two, also because these are consistently profitable strategies, consistently trading profit, but trading profits are based on extremely high technology investments. So if instead of calculating returns the traditional way, you said that instead of looking at trading margin as the source of fund and as the investment, I need to look at trading margin plus technology investment. Then the Sharpe ratio reported for a high frequency trading strategy still makes sense. Then it would become comparable, competitive, and so on. But if someone comes to you and says that I have a Sharpe ratio of 20, 30, that's because he's making money based on technology investments. So it's not a right comparison that way. So what factors do we look at? Okay, that would be an interesting way of looking at it. So the technology investment, the age in the strategy. So if it's a strongly latency sensitive strategy and then say tomorrow we get slower by a few microseconds and then we will never get the right trend. So how much of an edge is there in quant and how much of it, if it's a pure latency game, say for example, the USD INR trades in NSE, the USD INR trades in BSE. Now, whoever is the fastest, will, and the moment the currency price changes, we'll get to buy at the cheaper exchange and then sell at the expensive exchange. And if we become slower than our counterparty by even a few microseconds, we will not get to do the right trade. So the edge is not much. But then in contrast, if there is a quant angle to it, then we all believe that when the price of the future goes up, the price of the options should go up, and so on and so forth. But then there is delta, there is vega, there is theta, and so on and so forth. So there are some complexities. So it's not about being the fastest purely, because there are lots of predictions involved. The price of the future might have gone up, but then the price of the stock might not have gone up. The price of the future, the next month future might not have gone up. So because there are so many complexities, the game is not purely speed. So can you afford to be slower than the competitor by X microseconds, and will it still keep making profits? So that is another parameter that we have. So the technology investment, and then how consistent are those profits? So you might have a strategy which requires fast response, which is high frequency trading, but then it might not have consistent profits. So it might look at the order book, and then based on the order book, it might try to predict up moves and down moves. And so you could say that sharp, but adjusted for technology investments, yes. So that could be another way.
Okay. So, and what are the backtesting tool which you would recommend for an option trader? Like, if someone want to automate their trading strategy for options, because there are no much retail level option backtesting tools available in Indian markets, at least.
Okay.
Or should one have to custom build in Python or R?
Okay, so you will have to do this. We have always done custom built because our backtesting requirements are our own. So there could be packages that exist wherein one of my colleagues uses them extensively. He discovers all those interesting packages wherein people build features, and I end up building things from scratch every time, and then he uses existing platforms every time. So there could be, but then I personally prefer building things from scratch for my own specific requirements, my own complex requirements. So there could be. So because I don't use it, so I'm not. I know a lot of versatility and exist in R and Python packages.
Okay, okay, that makes sense. And I think, Raju, what you would like to say to a budding algorithmic trader? I mean, how to start his career, how to evolve as an algorithmic trader. What are the things you suggest to them to kickstart their career in algorithmic trading?
Okay, so the first thing is to, okay, so I'm not sure how many of you are cognizant, but the average lifespan of a trader is less than 1 month. That's the average lifespan of all traders everywhere. So yet we have such a huge pool of extremely successful people in the financial markets. The number of people in the financial markets is such a big number, and yet at the same time we also see that the total average lifetime is only 1 month. So why do we have such a discrepancy? That's because a lot of people do not do things in a structured, disciplined fashion. Now, the best way to do things in a structured, disciplined fashion is to use structure. And the best way to do it in a disciplined fashion is to use structure. How do you define structure? So you need to set up predefined logic based on quant factors, which is statistics. So the best way to do it is improving your understanding of such building blocks like statistics, etc., so that you can use them and to introduce structure in your strategies. Therefore, you don't end up trading discriminately on your. You don't end up trading discriminately on Remember we talked about discretionary trading. So the more it is a structured based quantitative trading, the more disciplined it gets, and therefore the higher chance of success. The biggest enemy of traders are greed and fear. So if you have it structured, there is no greed and fear. I always maintain that the biggest investment that anyone can do is an investment on their own personal skills. So I come from, with that belief, we started our education business, QuantInsti. So I'm not saying that you join QuantInsti, but I'm saying that you need to try to build up on your building blocks, which is statistics, basic to advanced, everything. Try to learn more about various trading strategies, try to figure out what people are doing, what kind of strategies exist. So anything to improve your skill. So read as much as possible, work on, try to have structure in your trading. You might have a trading idea that makes money, but then when you try to convert that idea into a set of instructions for a computer program, then your own understanding of your strategy will improve.
Okay.
When you have to convert convert the trading strategy that you have been trading every day, you look at the markets, you look at the screen, you trade, but then when you say that, okay, I need to convert my style into a set of instructions that a computer system will be able to trade independently without my interventions. If you try to convert your thought process into a set of instructions, your own thought process will improve. So and then it will become much more disciplined and structured. You won't end up doing discretionary random view-based trades, which are, or you won't get affected by greed and fear. So the more you try to convert your trading strategy into an algorithmic trading strategy, the higher the better your own understanding of the strategy becomes, the higher the success rate. So the average lifespan of a trader is 1 month, the average lifespan of an algorithmic trading strategy, because to build an algorithmic, to write a strategy in an algorithmic fashion, you have to devote so much more time and effort. The average lifespan of an algorithmic trading strategy is way higher.
Thanks, Rajiv. That was very brief. I think we had almost crossed the session timings. And,
Yeah.
I thank you, Raju, for your brief efforts in explaining the intricacies of algorithmic trading, and I hope we'll do some more similar sessions in the future as well. And I thank you, Raju, again for spending his Saturday with us, and thank you all the people out here attending the session. It was quite an interesting crowd today, more interesting questions flowing in, and it was very comprehensive session. I would say that I think you also believe so that, and Raju, what is your last comments about today's session, so that we can wind up with your final.
Last comment is always a very difficult question to answer. So I would say, if you have anything profitable, never delay maximizing, never delay scaling up, never delay milking it the most now, because you never know how long it will last, and the best way to scale it up is by going algo. So and then so best of luck. I hope the session was as beneficial to you as it was for the amount of time and energy with which I have spent it here. So I hope it was beneficial. You guys, I hope there was something new that all of you are taking back today, and I look forward to a long, fruitful relationship with you guys. Yeah.
Sure. And Rajiv, there are we have a private community in Slack. More questions are
Okay.
flowing in over there. Because of time limit, we cannot take the questions. Maybe we can take it offline. That questions, I'll give you Slack access. If you have
Okay.
time, we can take those questions later on in the Slack.
Okay. So just send me an invite to that Slack channel, and then I
Sure.
will
Yeah.
answer those there. Yeah.
Sure. Thank you. Thank you, Rajiv. And
Yeah.
thank you
Have a
everyone.
great weekend, everyone.
Yeah. Have a great day. Thank you.